Today we have a special guest with us. Todd Smith has worked in the banking and mortgage industry for almost 30 years and is currently the mortgage director at Bank Iowa, where he manages the day-to-day operations of the bank's mortgage department with 26 locations. Todd, really good to have you here today.
Thank you. It's a pleasure to be here. It's a real honor. I'm excited to have a nice little conversation about a topic I'm very passionate about. So
yeah, interest rates, mortgages.
Absolutely. Absolutely.
Love it. Well, yeah, really appreciate you being here.
Thank you.
To start, I'd just love to tell me a little bit more about what you do.
Yeah, so I have a little bit of a unique position at Bank Iowa where I kind of oversee both the sales staff as well as the operational staff. So it's a nice conduit between the two. I kind of officiate, so to speak, to keep both sides happy, but oversee the entire operation from that standpoint. We have an amazing staff at Bank Iowa that makes my job actually really easy. So
wonderful.
Couldn't be luckier.
You've worked in the industry for a long time. What I think our listeners would be curious to know, I'm curious too, how is a mortgage rate, when you think about mortgages, like how is that actually determined?
Right. I wish there was a simple answer. Historically, traditionally, I would say that a mortgage rate is tied to kind of the 10-year, a fixed rate mortgage is tied to the 10-year treasury.
Okay.
In our environment today, there are so many other economic factors that go into it. The Fed, bond market, as I mentioned, treasuries, we pay close attention to, economic conditions, and then lender-specific overlays from that standpoint. But the one thing that I think your viewership might be interested in, one of the biggest pieces is the borrower profile.
Okay.
A lot of people don't understand why, two neighbors might get varying interest rates for a 30-year fixed, and the GSEs in the form of Fannie and Freddie pass along loan level price adjustments, and they're based on your credit score, your debt to income, LTV, all those factors. Even loan amount can play, a factor in what the rate you see when you're out shopping for a mortgage. So,
okay, so what I heard you say is that there's a lot of factors.
Correct.
So not only like market pieces of information like treasury yields, fixed income yields, what the Fed does.
Right.
But also, I think it probably is easy to forget just the individual component. Do you see that a lot too?
It is. It's easy to forget, and I like to bring it up because, that's the only piece that we are in control of, so to speak.
Sure. As the individual.
Right.
Yeah.
As the individual borrower, a lot of these factors, they are what they are. We can't have an effect on them, so to speak. But it's a very macroeconomic derivative, I should say, on how mortgages are priced.
If you had to tell somebody like myself or anybody else, like what are the top 1, 2, or 3 things to really have under control to get the best rate personally, like what would that be? Like
the amount of debt,
income.
Right. So your debt to income is going to be a major factor from a loan level price adjustment that you would have control over.
Okay.
So, reduce your debt. I would also say it's a big deal to save as much as you can for down payment when you purchase. So the lower the loan to value.
Cash is king.
Right.
You just get that cash.
Right.
Yeah.
Right. So those are all things that play a big factor in what your final rate is that as a borrower you receive.
So market forces, the individual. So let's say you have the same individual. They might have a different rate at Bank A and Bank B. Why would that, like in the local market, like why would that be the case?
Each individual lender, I should say, sometimes they manage their pipeline through pricing, from a capacity standpoint. So that's why you could sometimes see a varying rate from A lender to B lender. It could just be or they could have an incentive that they're running at that given point or moment in time. So it can, I say pricing when it comes to a mortgage a lot of times is a little bit of smoke and mirrors. You're all going to get the exact same rate in the long run, whether it's through fees or the actual rate that you're paying. So
one bank might be slightly less. It might be just an intentional decision to maybe help drive maybe new customer acquisition.
Right.
Just they might make a little bit less for a little while
Exactly.
in exchange for that.
You're buying business to a degree for
Okay.
a period of time, and once you've hit that limit, you might then back off.
So probably something important for individuals to know, but being in the relationship business, I mean, making sure that price isn't the only thing.
Right.
It's I know groups like yours just treat their customers really well. So that's
Right, and that's a big factor. You know, as I say, you've got people that shop at Walmart and people that shop at Saks Fifth Avenue. You get what you pay for in a lot of cases, and that doesn't always mean that Saks is the higher priced, but the level of service, because there are a lot of factors that go into your rate. The fees that some banks charge, you know, whether it's a discount fee or an origination fee, that can affect your final rate as well. Some people have more cash to put towards it than others do. Right. So it's pretty complex. And, you know, I always encourage people to get a second quote so that you can compare apples to apples. That's always some of the best advice I give. We are always confident enough in the product and the rate we're offering that, hey, get another quote, see where we're at. So.
Is there certain things to make sure they have the best understanding of all those levers that someone should ask at that?
Well, you know, this industry is as highly regulated as there is out there. So they'll receive plenty of disclosures. Yep, it's standardized. You'll receive upfront disclosures that will spell out what your APR is, what the fees are associated with it, what fees are to you, and what fees are associated with a purchase. Depends on whether it's a purchase or a refinance, of course, but it's standardized, so you should be able to compare.
Okay, so when you get quote 1 and quote 2, it should be able to be pretty easy to get that determined. Great. Right. So there's mortgages, there's 30 years, there's 15 years, there's also ARMs, or adjustable rate mortgages. Is there any difference? Just curious about that.
There's
on how those rates are set.
Right, there's a huge difference. You know, in years past, ARMs were very attractive because short-term money was cheaper than long-term money. That's not really the case in today's market. In fact, outside of a portfolio product that we offer and most banks offer, we don't ever quote a conventional ARM product just because they're not any better than a 30-year fixed at this point in time. So, but they do, and historically they have had some advantages from that standpoint. You can bank on the idea of maybe rates are going down, so you could get an ARM and hope that your rate decreases. There's a lot of borrowers that only know they're only going to be in this location for 3 years. Well, why not get an ARM that might be a little lower start rate? So, but ARMs, I think, will become more attractive once short-term money becomes a little cheaper.
Once those short-term rates are a little lower than the long-term rates again.
Right.
You know, speaking of that, just makes me think of the Federal Reserve meeting today, September 19th, where the Fed just a couple hours ago, prior to us talking here, they decided to cut rates by 0.5%.
Right.
0.5%. Is it safe to assume that mortgage rates, I know they've been dipping a little bit recently, like a 2-year low, if I know right.
Right.
Is it safe to assume they're going to keep dropping a little bit further from here?
I think you'll see an adjustment. The market will react to that reduction of 50 basis points. But, you know, in theory, the Fed reducing Fed fund rates by 50 basis points really should have no effect on fixed rate mortgages. But that also affects the bond market, which is tied pretty closely to what 30-year fixed rate mortgages are at. So I would anticipate you'll see a reduction in rates here short term. Now, the market may then correct itself and they may go back up or stabilize. But yes, I would anticipate seeing a little bit of a drop.
And it might take a little bit, right? Is that right?
Yep.
Why doesn't it? If I'm listening in, why doesn't it adjust more quickly?
I think they wait to see what other economic factors are affected by that rate cut.
When you say they, are you talking about the bank?
The banks, just across the board, as far as how long will it take for treasuries to be effective?
To readjust,
Right. So, again, there's just so many factors, but I think public perception and things like that, assume it's going to adjust.
Yeah.
And sometimes I think they adjust just based on that idea. So
Well, it makes me just think of interest rates in general and just how unpredictable they can be
yes.
in the short run. So I know we're always talking with our clients about, here's what we know now, but especially interest rates, they just seem to be notoriously so hard to predict
Right.
or foresee exactly what's going to happen.
Right.
At the start of this year, it seemed like we're going to have rate cuts back in the spring, but of course that didn't happen. So yeah, focusing on, hey, let's plan, think about your own personal situation. And like you said earlier, I mean, that
Right.
tends to impact things more than anything else.
It doesn't. You know, historically where rates are at, I would say that a 30-year fix probably needs to live in the sixes, to be perfectly honest. And historically, that's still a very low rate. It's, I think it's below the 30-year average. So if you can afford a home, you can, at the 6%, I think, take advantage of it. Move forward with it.
So maybe not those 3%. 3% years
I'm
might
not sure
be
we'll
gone.
ever see those again, but who knows?
Yeah.
I never thought we'd see them the first time. So
Right.
right.
Well, that's all really helpful. Thanks for sharing about mortgage rates and interest rates. Is this, just a lot going on here recently, just in that arena.
Right.
So-
No, it's been a volatile market, and we have a lot of customers that are still sitting out there at the 2% rate and don't want to move. And
I know some people like that. It's like,
Right.
I'm locked in. I'm not going anywhere.
Absolutely.
Yeah.
And so we'll see if rates dip a little bit, it could encourage some of those people maybe to upgrade their house or do something different. So, or downsize or whatever fits their life.
Yeah. Well, where we are now, certainly better than where we were just, 12 months ago.
Right.
Was it 12, 18 months ago?
Yep.
So, Todd, thanks so much again for being here. Really enjoyed the conversation.
Thank you.
And for listeners, if you want more information on Foster Group or other topics, please just click the link in the show notes or go to our website, fostergrp.com. Thanks again.